Hard to believe Keith Whitley died at age like 35. Alcohol poisoning. Horrible. Just horrible. Let me mute everybody just a second. We'll get kicked off here. Hope you're having a great week. All right. So welcome in. Remember I told you the market doesn't care what race you are. It doesn't care how fat you are or how skinny you are or how smart you are or how dumb you are or how much money you have. It doesn't care if you're, a king, a queen, or a pauper. It has no idea who you are. It is there to rip you to shreds and to kill, steal, and destroy your money. It's there to take from you and to give to those who are prepared and ready. So imagine my surprise today. Y'all, I talk about things a lot outside of the class, but I think it's important we have these kind of dialogues. I'm just shocked today. Somebody went into one of my photos from back in the fall and commented on one of my family photos. And there are my kids. And they said, "Hey, whose son is this?" And Beth said, "That's my son." And he goes, "Wait, he shouldn't be your son. He's black and you're white." That just killed me, y'all. So this guy goes into this racial rant, talking about my kid and how I shouldn't be raising my child because he's black, and I need to return him and all kinds of stuff. And I simply said, now y'all, I'm a sinner saved by grace, but sometimes I got a little language problem. So I wrote on Facebook, I said, "Let me tell you something, pal. I love my baby and I'm going to whoop your ass." So I'm blocked off of Facebook for 3 days. Unbelievable. So somebody can talk about my baby and taking my baby away, and I don't know. I'm really upset about it. You don't believe that there are people out there like that? My baby needed a home, and it's kind of interesting. There are some people that when they would take foster babies, they would say, "Oh, I only want a kid in perfect health, or I only want a kid with blue eyes, or I only want a kid that is white, or I only want a kid that is black, or I only want a Hispanic kid." And not once in the entire 16 children that came into our home through the foster process did I ever say, "Hey, is the kid white? Is the kid black? Is the kid blue? Is the kid brown?" I didn't care. That wasn't something that we worried about. And for that gentleman to insinuate that I can't raise my child in a loving, wonderful home really just ticked me off. And especially, to kick me off Facebook, because I will whoop his butt. But I mean, I'm a brawler, baby. I'll take care of business. Don't threaten or say things bad against my family. I probably just could have. What would Jesus do? Calm down just a little bit. But anyway, so that's my spiel for today. And that's why I like the market. And my son, JoJo, I think I showed you, he dressed up to go to school like his daddy. He wants to be a trader. He wants to be an investor. He wants to take a briefcase with him. He wants to take a calculator, and he wants to be a trader. He wants to sit behind screens and trade and do the things that I do. And it's just wonderful. And fortunately, he can go and sit behind a screen and do the things that his dad does, and nobody's going to care, that his father is white, or that he is black, or what his status is in life. Nobody's going to care. So he likes to press the buttons. He loves the charts when I turn on the charts. And he'll sit up here and I'll let him make trades. We'll push buttons and stuff. I mean, he's 7, right? So I don't know. It's just precious. And, JoJo doesn't wake up and say, that, "Oh man, Dad, we're different, so I can't be here." And it's just, and my other kids, I got Hispanic kids, I got white kids, I got black kids, I got everything. And nobody looks at each other and says, "Oh, you shouldn't be here because you're this color." And I wish so many people could look at things the way that my kids look at things. And unfortunately, they don't. It's just really, really sad. it's a poor reflection on our society. But I know that the vast majority of people believe like I do, and if they don't, it's just I don't know. I don't think we have to have people that believe just like we do, and I want people to have their own ideas. But to openly come onto my photo that was posted back in October and to say, whose kid is this? Almost like, hey, he's going to try to, come take my kid away from me. Well, let me tell you something, pal. Come on, baby. Big Daddy is locked and loaded. You'll pry my kid from my cold dead hands. But anyway, that has nothing to do with trading or anything. But I just thought it's interesting. I want y'all to think about it. How many times maybe that you have been discriminated against in your life, or where racism or some type of phobia about your lifestyle has crept up, and how it's been used against you. Fortunately, you can go into the markets and into your investments, and nobody's really going to care. I guess unless you're in real estate, right, where they could actually see you. We had a full session on real estate, but when you're behind the screen doing your 401k work and doing your trading and your investments, it's not something that's ever going to come up. Nobody knows, what your sexual orientation is on the other side of your trade. They're not there to say, well, if you're this or if you're that, we're going to try to take advantage of you. So that's why I love the markets. The markets are the great equalizer. And if that fool's in the market, I'm more than happy to take his money on a daily basis. And the people that are prepared will take your money. All right. So have any of you downloaded Tastyworks? Does anyone have a Tastyworks platform like I'm seeing here? I want some of y'all to be guinea pigs if you could open the platform up. If any of you have Tastyworks and can open it, I'd like to make it where you can share your screen, because we're going to make you the guinea pigs today so that you can actually do some trades today. You can, and the reason I want to do it in Tastyworks oftentimes is because it's easier to build the trade. Sometimes in Thinkorswim, it's kind of difficult. So I would encourage you to open a Tastyworks account. You don't have to fund it. Now, if you fund it, they've got a thing going on. You'll have to search for it. Don't just open an account and put money in it. But they've got a thing where you will get $200 worth of stock. Now, I don't know what the stock is. And $200 isn't a lot, but it's something, right? So they'll give you $200 of stock. And if you don't like what stock they give you, you can sell it, I guess, and buy something else. But it's kind of cool that they'll give you a little, little play money, a little $200 worth of, or is it 200 shares of stock? $200, 200 shares, something like that. Maybe it's 200 shares. So look for that little promo, open you an account. I'm not sure if you have to fund it to get the amount. You may have to put some money in there. But has anybody got it that could share today that has Tastyworks? If not, I'll, okay, Beth says, don't allow a single person. Oh, this is a direct message to me. Yeah, he's not worth my time. Yeah. Yeah, we love our little family. We really do. And, it's just crazy that some people don't accept us. And hey, listen, there are people who don't think that gay couples should, foster and adopt children. And I'm going to tell you something. Some of my dearest friends are gay and have adopted and are the best parents on the planet. Matter of fact, some of our friends, when JoJo was in the hospital, I mean, JoJo had to be life flighted. He had a little surgery and he didn't come out of the anesthesia, and they had to life flight my little baby to Atlanta. And of all our adoptive and foster parents that came, guess who came? Only one person, and that was our friends that happened to be gay that came and supported us while we were in the hospital. Nobody else came. So don't give me, that, because someone's orientation is different, that they can't be adoptive and foster parents. I don't know. We just so judgmental on everything, right? And it just breaks my heart when I see these type of things. So anyway, I'm on a tangent. All right, who has Who has Tasty Works? Anyone that can open it, do anything with it? If not, I'll do it. I want someone to put on a Rick trade today. Now, let's talk about the Rick trade just for a minute. And really, I just want you to put this on because I want you guys to kind of manage this trade. Okay. Now, the Rick trade is normally put on a Monday, Wednesday, or Friday. So, and all it is it's a defined risk strategy. When you sell a put, it basically has unlimited risk, right? But you can define your risk by buying an option below the one that you're selling. So let's see what that looks like, okay? So we're in SPX now, and let's just say that you're going to do a, let's clear this, because it's easier to see on Tasty Works, so I'll let you see this. So let's say that we're going to do a short put option, right? You're going to sell a put. So let's say you go down to a 30% probability of being in the money, or let's do one standard deviation. One standard deviation is at 16%. Yeah, anyone got a question about standard deviations? Let me draw it for you. So y'all know what the normal distribution curve looks like, right? This is a normal distribution curve. And we know that 68% of all occurrences happen within one standard deviation. So what does that mean? That means that over here, there's 16%, right, of occurrences will occur down here, and 16% will happen up here. So if you add all that up, 16 is 32, 32 plus 68 is 100. So within one standard deviation. So when you're selling something that is a 16 delta, you're basically saying, hey, that gives me, you know, a high probability that 68% is going to occur right here. It's not going to go down here, right? So if I tell you to go 2 standard deviations out, that's right at 95%, right? 95%. So it moves it out a little bit. So 95% of all occurrences happen within 2 standard deviations. So then we go out 3 standard deviations. I can't remember exactly what 3 standard deviations is, but it's roughly 98%. 98% of all occurrences happen within 3 standard deviations. So if you sell the 16 delta, you are at this point in time. You are 1 standard deviation away from where the current price of the underlying is. All right, any questions on that? And we can do the normal distribution. The bell curve works in everything. It works in this class, right? 68% of you are pretty much, you know, your average students. 16% of you are top notch, baby. And 16% of you are a little bit below average. You can do this on everything. The normal distribution curve, the bell curve, is applicable to just almost anything in life. It really, really is. You know, most of the people fall within 68%. So most of you will have a lifespan of, you know, 70 something years, right? 70 something years. Most of us, you know, will fall within so many years here and so many years. So 68% of us will be within this range, right? Maybe this is upwards of 78 or so, and, you know, maybe right down here we're, you know, 57 or so, whatever that is. And then there will be some of you who will live to 90 and 100. You'll be outliers, so to speak. You'll be in this area. And then there are some who die as infants, who die very, very, very young, right? The Keith Whitleys of the world, who brought it on himself, alcohol poisoning, right, at age 35. So 16% of the population will die here. 68 will die within a normal distribution, and then 16% will be up there. So it applies in so many different areas of life. Okay, normal distribution curve. So that's what we're saying. Now, when we sell the 30 delta, what is that? That's basically a half of a standard deviation. All right, so a full standard deviation is 16 delta. Half of a standard deviation is around 30 delta. So that's why a lot of times we'll use those numbers. So if you're going to sell a 16 delta or 16% probability of being in the money, check this out. That's going to take $89,000 of buying power in this account. Oh, behave. Oh, that's a big, well, big cookie. Your max loss is $457,240, and your max profit is $760. So most accounts simply can't do that, right? So what we do is say, well, let's cap our loss. Let's make this not a undefined risk trade. Let's make this a defined risk. So then you could say, hey, I could do a short put spread. So I could do a short put vertical. That's what it's called, a vertical, short put vertical. So this is 5 wide, right? So here you're collecting a credit of $2 for something that is $5 wide. Everybody see that? So now your max loss is $290, $295. Your max profit is $200. Now, I'm just going to give you some just little rules of thumb here, okay, to kind of help you in determining how far apart you want these things. So here's what you want to do. You kind of want to collect about 1/3 the width of the strike. 1/3 the width of the strike. So if you have a $5 wide strike, right? Let's go and do the math. If we're doing them 5 wide, how much credit do you want to collect? So you do 1/3 of $5. So 5 divided by 3 is $1.66, $1.67. So here we're collecting $2.10. So I would move my strikes down until we got that to about $1.65. And the reason that we do that is that's giving you a 63% probability of success. That's where you want to be. Now you can move it out, right? You can move it way down, collect a lot less credit, have a greater probability of profit, but you're going to increase your max loss. So kind of a sweet spot is to find something that is about 1/3 the width of the strike, and we think that's around $1.56. So you could put this trade on. You have a 64% probability of profit, that is making a penny. You get $9.36 of theta decay. So basically, these options should decay or rot each day, giving you $9.36 in your account as profit each and every day. Your max profit is $1.60, and you have positive deltas, and you're only taking $3 or $340 worth of buying power. Okay, so if we're doing a Rick trade, though, here's the way Rick does it. And he does it on Monday, Wednesday, Friday. Now, he doesn't collect 1/3 of the width of the strike. He does this. He does a 20 wide strike. So he sells the one here, does it here, and he does it at the 5 delta. So the short strike is at the 5% probability of being in the money. Now watch this. He doesn't collect that much credit. So let's go down, do it here. There's a 4% probability of being in the money. Here he would collect $1.70, right? Much less than the thing. But look, he's got a 90% probability of profit. His max profit is the credit received. His max loss is the width of the spreads, which is 20 wide times 100 is 2,000 less the credit received. Everybody see how to calculate that? If you have a $2,000 width of the strikes and you collect 175, then 2,000 minus 175 is the, what is that, 1825? 1825, yeah, that's your max risk, right? Yeah, 1820. All right, so here's what he would do. He would go down to do about the 5 delta, or 5% probability in money, do it 20 wide, and he just does this day in, day out. Now, what if this trade goes against you? What if this trade, what if we know that there's a 5% probability that the strike will be breached at expiration? What does he do? Whenever SPX goes from what it is now, 4609, he sets an alert, and you can set an alert on these things to alert you that when the market hits 45.55, what he does is he creates a roll order. Let me tell you what rolling is. Rolling is theoretically nothing but closing the existing trade and moving it out farther in time. So if this is 1 day to expiration, he would move it out to 3 days to expiration. And he's trying to do that for a credit. Okay, trying to do that for a credit. So he may have to roll those strikes out in time, and he possibly may roll them down as well. So he may roll it from the 45.55 to the 45.50, 45.35. That's what he would roll it, and he would roll it from 1 day to 3 days. How do you do that? You click on your strikes, and you right click, and you say create rolling order. It's really, really simple. And maybe I'll show you of something that I've got. Let's see. Let me show you a position here. Show you how to roll. It's really simple. So what all positions do I have here? Okay. Let's just pretend I'm going to roll this one. All right, I got 16 days to go on this. All you got to do is right click and do quick roll. So I'm rolling out in time. So now it took it to 24 days out to the same strike, right? Same strike. I'm closing or buying that option back at 42.05 in the April 14th expiration. And I'm reestablishing the position in a 24-day expiration at the same strike. And the cool thing is I can collect another credit of $450 by doing that. So you're extending duration and giving the trade more time to work out. Now, what I do is if this strike had been breached, I may try to roll this from the 42.05, and I may try to roll it to the 4200, or to make it safer, right? Farther away from the money. See, I can go further down and still collect a nice credit. So that we're giving the trade additional time to work. So in this instance, you don't want your strike to be breached. So what do? You roll it out in time. You're able to collect an additional premium, and you're keeping the dream alive. That's what a roll is. Any questions on a roll? When I think about roll, I think about the old, y'all remember old Charlie's? Not old Charlie's. What was it? It used to be, oh man, they had them all in Alabama. What was that store? They're like Shoney's. Quincy's. Y'all remember the old buffet bar Quincy's? You remember? Nobody remembers that? Oh man, the rolls were so good with the honey butter. Oh, can y'all tell Tubby's on the diet? It's killing me. Killing me. All right. Nobody, raise your hand if you remember. Nobody remembers Quincy's.
I remember that.
There you go, Christiana. That was so good. And they still got one in Tennessee. So Catherine remembers it too. Christy remembers it. Oh man, I love their rolls.
Never heard of it.
Oh, it was good. They still got one in Tennessee. And when we, not Tennessee, maybe North Carolina or South Carolina, I don't know. When we come back from vacation from Myrtle Beach, that's where we normally see one. And we always stop, and it's so nostalgic. And then I'll have to tell my kids, Daddy used to eat here when I was a kid, and they roll their eyes, All right, so that's rolling, baby. That's rolling. So let's go back to our SPX, and I want you to just put on the Rick trade. Do this in your own account, okay? So what he's doing is Rick does these Monday, Wednesdays, and Friday. But what we're going to do, let me clear it, show you again. Here you can go, I'm going to do a short. So your selling options put vertical, all right? He makes this 20 points wide. Everyone sees that. Then he moves it down to the 5% probability of being in the money.
Can you show me a minute? Because this is where I get lost.
where am I seeing the 20 points wide? And if I'm being a blonde, forgive me for a moment, but I'm trying to follow what you're saying.
Yeah, I want y'all to totally follow. So when I'm saying 20 points wide is we're selling the 45.60. So
I see it.
so subtract 20 from that. So that's the 45.40. So you're buying one 20 points below your short. That caps your max loss at $2,000 less the credit received. This is what we call a defined risk trade. If you had done this naked, then you could lose the whatever amount it was. What was it? $450,000, right? If we take this one off, let's do this. Yeah, you could lose the 455,000. But by buying this one, you cap your loss to 1850. And you give yourself a 90% probability of success. Your maximum profit on this trade is $1.80 times 100 is $185. Will you shut up? I'm sorry, y'all. That's my new dog. Unbelievable. You know what? I'm excited about this trade. So this trade expires Wednesday, right? I'm gonna put it on in my account right here. So reduce by, oh, it won't let me do it in this one account. Okay, because this one didn't have. And we do need to talk about this. This is a smaller account. I put this same trade on in another account. You need to know about pattern day trading. I don't want to talk about it much now, but if you have an account that is less than $25,000 in available capital in there, then you cannot open and close more than, what is it, 3 round trip trades in a week. It's a stupid rule. It's trying to protect consumers, but it's stupid. So what we do to bypass that, I'll show you in a minute, is we trade futures and futures options, because futures and futures options are not subject to the pattern day trading limits. And so I would recommend, if you're not trading SPX, in an account that's greater than 25,000, make sure that you do it in the futures. So you could certainly do this in a futures account. All right, but now that we've built the trade, everybody sees the trade, 45.60, 45.40. We know what the game is. I like to go, now you can do it in here, but it's just easier to build a trade here because it's easier to move strikes and Tasty Works. It's easier to navigate around. But now let's go. Everybody, Lisa, help me remember, because my mind, y'all know my mind. I'm ADD, ADHD, I got all this stuff. So 45.60, 45.40. So let's go build it over here, okay?
Bobby, how far out is that trade?
1 day, it expires tomorrow.
That's what I thought. Okay, I thought I saw that at the time.
Now keep in mind, Brad, Rick would have put this on yesterday, right? Because he puts it on pretty much at the end of the day, 15 minutes before the market closes at 4 Eastern time. So he puts it on 3:45 Eastern time, and he puts it on for 2 days. But basically, why I want you guys to kind of play with this in your account, I want you to know how to roll. I hope you get tested. I hope the market goes down so that you'll see how to manage a trade, right? That's what I want you to do. I want you to see how to manage a trade. So let's go put it in here. So we'll go trade. We'll put it in SPX, and we'll go 1 day. So what was it? The 45.60? Is that right, Lisa?
Yes.
Okay, so we're going to left click on 45.60. Now, here's the weird thing about Thinkorswim. Now, you got to go down 5, 10, 15, 20, right? You got to hold your control key down, hold the control key down, and hit the ask. So that gives you a, gives you the trade here, right? So, and then you can do confirm and send and put the trade on. So max loss, max profit, 170, max loss is that, and it's going to take 1831 in buying power, which is the amount of your maximum loss. And in this account, I would still have $80,000 to put on more trades. Okay, that's how you do it. Then hit confirm and send, and to get that trade in. So I want y'all to put a short-term trade in, because here's what I want you to then do. Then I want you to go and put in an alert. Gosh, if I can remember how to put in an alert of where your short strike is. So if your short strike is at 45.60, and two, we could have built this trade here. Let's look at it again, because you want to go down basically to where there's a 5% probability of being in the money. Now you see, I've already got a position at the 45.30 and the 45.10, 20 days wide, that expires tomorrow. So what's going to happen is on my trade, and that's probably where you would go. So the probability of being in the money and the deltas are a little different from Thinkorswim to Tastyworks. You're in that general area though. So I actually use this, and you don't have to go to Tastyworks. So you could just say, I'm going to sell this one and I'm going to buy 120 points lower. Right now, watch this. Let's see if we can put an alert. How do I do an alert? Alert. I always do them on my phone. Let me see if I can do this here. Order, market depth, create relevant order, create closing order. That's a good question. All right, I may have to search that and share that with you later. I'm trying to remember, because most of my trading, y'all, is done on my phone, right? So that's where I do most of my trading. But it's easier to show you on the desk, on the desktop here. Let's see if I can do an alert. There we go. I think we can do this here. Let's analyze, create alert. There you go. Create alert. Y'all see what I did? I right clicked on my short strike and I go create alert. All right, so it brings it up. So SPX, spread single, blah, blah, blah. It tells me what my trade is there. So I want to go when the mark, which is what it's currently marked at, is at or below. No, I don't want to do spread. I want to do single. And single. Beth, will you do something with my dog? I apologize, y'all. SPX. I don't want to do a single spread. Hold on a second. Spread. Yeah, throw a rock at it or something. Here we go. Stop. There we go. So do SPX, and instead of spread, change that to stop. When the mark is at or below that area. What was the area? 40, 45, 30. 45, 30. All right. Everybody see how to do that? So when the SPX stock, when its price is marked at or below 45.30, create an alert. Create.
Does Tastyworks seem to be a little bit easier platform to use? It seems every time that we're on there, it's a little bit easier to understand.
It's more visual, isn't it? It certainly is more visual. So, Brad, if I could combine Thinkorswim with Tastyworks, it'd make my life so much easier. But I'd use them both. I'm sitting here and I use them both. Trade in both. But yeah, there's some things. I mean, for example, I can't do certain spreads in Tastyworks as one trade, whereas I can do them as one trade in Thinkorswim. So there's things that I like about one over the other, but they're both good. They're both good. You probably need to make a decision on which one that you want to go with. All right, now, who will be my guinea pig and will bring up Thinkorswim? Who will share their screen? Has anyone got the desktop platform up and ready to go? That can, because I kind of want one of y'all to hit the buttons.
I wanted to. I've been registered for 2 weeks, but it's just not functioning.
It's not functioning? Okay. Gotcha. Anyone else that can share would like to do a trade? Where'd Kyle go? Oh, there's Kyle.
Sorry, no, I don't have, I can't share the screen because I have Thinkorswim on my desktop. I'm always on my iPad here.
Okay. Lisa Benton,
Sorry.
do you have it where you could share? I kind of want one of y'all to.
I do not have it.
Okay. Okay, no worries. No worries. I just wanted to kind of let y'all be the guinea pigs, right? I want y'all to know, I want to see y'all pushing buttons. All right, let's do something now that I want to show you. So remember, if you've got an account less than 25,000, your let's see, let's see if we can find the pattern day trading room, which is the stupidest rule ever. Let's just do a little Google for pattern day trading room.
And is that a general rule or is that just with Tastyworks or just with
No,
Tasty?
that's the administering bodies that make this stupid what is FINRA, who executes 4 or more day trades in 5 business days and a margin account. The number of trades are more than 6% of the total trading activity. In other words, they think that y'all are dumb and that you are not capable of doing, 4 or more day trades in 5 business days. So it's really a stupid thing, but it doesn't bother us at all because, first of all, I don't want you trading individual stocks. That's what it would work with. So what you can do to get around it is trade. I'm going to show y'all the greatest thing ever for smaller accounts. You ready? I love it for bigger accounts too. This, ladies and gentlemen, is the micro E-mini S&P 500. Now, remember, I've showed you, now see, it's currently at 4606.50, right? And I've showed y'all the E-minis, which is the big boy, right? This is the big future. See, it's the same price, but it's like 1/10 the size of the E-minis. So we go to the micros. Oh, I love this little product here. Oh yeah, the micros /MES. Now, if you want to do the NASDAQ micros, that's /MNQ /MNQ. If you wanted to do the NASDAQ. So this is a cool little thing here, right? And I trade these like candy. I love the micros. Doesn't take up near as much buying power. You get to use something called span margin. So there's regular margin that you guys have in your accounts, but with futures, you get to use span margin. So whereas that trade in SPX a while ago took up, what was it, $450 something thousand of margin? What's this? Yeah, let's do this. Let's delete this leg. So see, this is going to take up $455,000 of margin, right? You can't do that unless you got a $500,000 account. So, well, actually, that's your max loss. Here's the amount of buying power that it takes. So they're going to make you put up $86,000, but you could lose $455,000. So this is regular margin with an index. So check this. I put in the E-minis, and let's sell that same naked put, 4560. Where were we at one day, right? So let's change and let's go down and sell that same 4560. Now, my buying power, instead of being $89,000, is $14,533. Now, there's a 50 multiplier on this. So if you were, collecting $100 on SPX, you're going to collect half as much on the E-minis, right? It's half of whatever you're collecting on the SPX. But what I love about the micros, check this out. What was that? The 4560. Now they don't have as many expirations, but 4560 here, you sell this little puppy. Look, it only takes $1,500 in buying power. But it's 1/10 the size of the E-mini. So this is something that you can trade that uses span margin. Now you got to know about span margin. Span margin is a favorable margin that is available on futures. But keep in mind, it is more dynamic. If crap hits the fan, the margin requirements under span margin, which is used for futures, can increase and elevate significantly. So therefore, I would not place more than 35 to 50% of my account in span margin, probably closer to 35. So if you got $100,000 account, when you're putting on trades, the buying power used, I probably wouldn't use more than $35,000 in buying power for your entire account. You would want to keep 65% of your account in cash. Because if the market crashes against you, the buying power requirements increase under span margin, you could get a margin call and they say, you don't want that. Okay, you don't want that at all. But let's just show you what I'm doing in the micros that I think is pretty cool. And I'll show you this kind of cool trade. So does everybody know how to put on a Rick trade? Everybody knows how to put on a Rick trade. It's a 20-point wide put credit spread where you sell one at the 5% probability of being in the money. Then you go 20 points down and you buy one. And he normally puts these on Monday, Wednesday, Friday. You can put one on today, on a Tuesday or Thursday, if that's when our classes are. So no problem there. So I'd like you to kind of do that. I'd like you to set an alert if the market kind of crashes down to your short put and that it breaches your short put. I want you to roll it. I want you to right click on the trade. I want you to roll it out in time for a credit. You may have a question about that.
I have a question.
Yeah,
Kyle.
When it, oh, did someone, okay, sorry, when it comes to being assigned your option, can that happen anytime the value of the underlying is below the strike price, or can it only happen when your option expires?
Okay. Great question. How do I answer this? SPY is an American style option. Okay. It can be assigned prior to expiration. Okay. SPX is what is called a European style option. SPX cannot be assigned at all because in it settles to cash. Let me make sure everybody understands that. If you're in SPY or Apple or Tesla and you're selling a put and your put is breached and deep in the money, it is possible that someone on the other side can exercise that option prior to the expiration date. Right? With an index like RUT, RUT, or NASDAQ NDX or SPX, those do not have any assignment risk because those do not, you can't buy SPX shares. There are no shares of SPX. So everything is cash settled. So whatever your profit or loss is on your options, it settles to cash and is either debited or credited to your account at expiration. Now, here's the thing with futures that's a little crazy. Futures, like the micro E-minis here or the E-minis, futures options settle not to shares, right? Because SPY would settle to shares. If you're short a put and you are assigned, on those shares, you receive 100 shares of SPY stock of the ETF. On futures, if you are short a future and it expires in the money at expiration, you will wake up the next day and you will be long a futures contract, not an option, but an entire futures contract. So it's kind of deep. So what we do to make sure that that doesn't happen is we try to manage these trades prior to expiration. Now, the SPX trade that has a defined risk, the only thing you're going to do is let that expire tomorrow. When you put that on today, let it expire tomorrow. And you'll need to put that trade in before 4 p.m. Eastern time today, 3 Central. Well, that's not theoretically correct. I think you could do it through 4:15. But I would do it around, 15 minutes before 4 o'clock, put your order in and have that thing expire tomorrow. Now, chances are you're going to make the full $160 or $170. If your strike is breached, your alert will pop up. Thinkorswim will, send you a little message. It'll pop up, blah, blah, blah. The alert that it's been hit, then you would roll that out in time. Generally, you would roll it from Wednesday to Friday so that you collect an additional credit. But yeah, if a future expires in the money, then you're going to wake up either long the future or short the future. So a lot of good questions and a lot of things that you guys kind of need to see happen on a paper account so that you're not taken back, with, when this would actually happen in a real account. And let me say this too. I want to say this. Some of you have been asking me, hey, Bobby, I really want to incorporate this into my portfolio. You're not ready yet. Most of you are not ready yet. You think you've got the knowledge and power, and with knowledge and power, comes great responsibility. So I'm teaching you how to do it, but I still want you to paper trade it a while. I want you to get really, really comfortable where you can hit the buttons and make the trades and know what you're doing, know what happens, know what your risk is. You're not ready for that. So if you're putting your money into SPY in your, or S&P 500, a low cost fund, and your dollar cost averaging into that every month, that's what you do. That's what you do, right, with your main account. So with this is something that's going to enhance your returns. It's going to enhance your account, but don't go full blown, guys, on this. Okay, don't do this. I'm teaching you a lot of stuff. I'm giving you a lot of knowledge, a lot of wisdom out there, but I want you to make sure that you are paper trading this stuff. Paper trade it first. Get a feel for how these things move. But let me just show you what I'm doing right now, and I think you'll like this because let me show you what trades I have on in the micros now. You'll love this.
Bobby,
So,
real quick, and
yeah.
can you answer this real quick before we switch to the next thing? For Rick, is he collecting 3 premiums or 3 credits a week on average then, because he's doing the trades or within a week period? Is that what's happening?
Yes.
Okay.
Yes. Overall, he's doing 3. Now, there are times when he has a feel for something, like a lot of times now he's not putting on the Friday trade for Monday expiration because he's worried about the war and the risk over the weekend of what could happen. So sometimes he's taking Fridays off, and it's just kind of a feel thing for him. And hey, Brad, make sure, guys, that when you're doing this in your paper count, change your number of contracts to 1, right? Don't do the 10 contracts, right? Because Rick is trading 35 contracts. So he's going to collect that $1.70 times 35. He's collecting a bundle of money. 95% of the time he's right. But what happens when he's wrong? I want you to keep doing this. So when Wednesday comes tomorrow and yours is about to expire, I want you to put another one on, expiring for Friday. I want you to play with it. And I'm hoping over the coming days, you get to see what happens with the Rick trade if your strike is breached. Okay, any other questions? Let's tidy up. Any questions you guys have so far?
I'm going to ask one more because we're getting so in depth on some of this stuff. Is there anything that bridges kind of where we started this class to some of the concepts that you're talking? I know you have the YouTube channel, but and I think we described it. It feels like sometimes we have this huge onion and we're that little thin layer, not even the meat of the onion. We're that little thin covering over the onion that we're trying to dig into. We got so much more.
Mm-hmm. Here's what I would say. I would go to Tasty Trade, which is Tom Sosnoff's group. I would look at all of their market measure segments. I mean, going back to 2012, I would start looking at those market measure segments. I would never tell Tom this, but 80% of the stuff that they put out, I would call fluff, right? But there's gold in that 20% of the market measure segment. So they have an actual 15-minute segment every day called Market Measures. And it is great education. It's totally free. The second thing that I would do is I would look at, and you can go, let's just pull up Tasty Trade so I can show you this. Tasty Trade. And you can see they've got all these, all the content that you can check out, but the market measure segments, I would definitely go for those. Let's see, market measures. Y'all see market measures scream at me. For some reason, I think I've already passed it. There's also another series that's really, really good, and it's called Mike and His Whiteboard. Mike and His Whiteboard. Let's see if I can say Mike and His Whiteboard. Y'all help me if you see
The one
it.
you were looking for was right up top, Bobby.
Was it? Okay, let's go find it.
Yeah, it was the very first one.
Ah, there it is, market measures. Right. So I would go back probably and just start absorbing those. The options drive segments are good. Oh, here it is, Mike and His Whiteboard. Yeah. Mike does a great job of teaching so many things, you know, strategies, how to avoid locking in losses. And he uses a whiteboard and is very visual. And what does it say? Load 25 more episodes. So yeah, he's got several episodes here, and they're pretty short, right? They're like, 5 or 10 minutes each. And you could go in here and talk about portfolio strategy, cost reduction, debit spreads, all different things when it comes to trading options. Great content. It'd be really good for you. Okay, so those are the two areas that I would focus on Tasty Trade, and it's free. Now, there's paid content, and there's people all over YouTube trying to sell you every kind of course, and that's how they make their money, right? They sell these courses, and most of them are not worth your time at all. You just spend a lot of money and help somebody to, have their beach condo or whatever, because they're not making their money from trading or from investments. But I wanted to show you, now y'all, this will be a little scary for you, but I want to show you in one of my accounts, my positions in the micros, because I put one of these on every day. And check it out. You see here, this little flag is the current price of the micro, right? Current price of the E-minis is at 4605.75. And wherever you see green, those are my profit humps, right? Those are my profit humps. Wherever you see red, those are areas where I could lose money. So you see right now, I am in a profit hump, and I'm in a profit hump all the way down until 37.20 is my downside break even. All right. So this is kind of a cool thing. And I'll just show you this really, really quickly to let you see this trade, because I think it's kind of cool. The trade that I put on every day is called a 111 trade. Let me just show you this trade 111. Go back to table mode. And what I do is I go out closest to 60 days without going over. Why 60 days? All right. Theta decay. Let me tell you about theta decay of an out of the money option. Looks like this. Here's theta decay. Right. So maybe this is 90 days to expiration. Maybe this is 60, 45 days to expiration. And then here you are at expiration. So all of the extrinsic value of that option will go to zero. Okay, so if you're selling an out of the money option for, let's say, $1, you collect $100, right? So this thing will go from, its extrinsic value will go from $1 all the way to zero here. Well, where is the sharpest part of the decay? The sharpest part of the decay is around this 45 days to expiration. That's why we like going out 45 days, give you time to be right to sell those options, because that starts to decay, right? It starts to decay to zero. Now, when you're doing the Rick trade, you're right here. You've got some serious decay. So whatever you sell today for $1.70, all of that $1.70 extrinsic value, which is the value that it has for being an out of the money option, below the current value of where, you know, the actual price is, that goes to zero. Now, if that spread that you sell becomes in the money, so that the price of this becomes below your strikes, then you have what's called intrinsic value, which is in the money. And that's where you got to buy that thing back to close it intrinsic. You know, in other words, you want the balloon that you sell for $1 to deflate so that you can buy it back for nothing at expiration. All right. But what happens is, if the price of the E-minis crashes or SPX crashes, what happens? That balloon that you hope deflates all of a sudden becomes a basketball. That's where you lose the money. That's where you lose the money. But let me just show you some simple trade that we put on. We call this the 1-1-1 trade. It's really, really cool because it has a built-in hedge to it. So what we do is we go out, I go out closest to 60 days without going over. And I do a long put vertical. Now, what is a long put vertical? A long put vertical means that I am buying an option, buying one closest to the money, and then selling one that's 50 points down, right? So in this event, and I'm doing it to where I can buy it for $10. So right here, it's at 16.25. So I got to move that down. So I move my strikes down, and I want this to be about $10, because that's where I'm wanting to pay $10. And I'll show you that in a second, what it looks like. There's 11.50. Down one more. With that, it gets hung 50 wide. There's 10.75, moving it down to 10.25, 9.75, and I move it up to 10. So I can buy this for $10. So this has a 35% probability of success, negative theta. My maximum profit is 200. My maximum loss is 50. Now that's kind of weird, right? Because we're normally buying options, but this is, I mean, we're normally selling options. This is buying a put spread. So what does this look like? Let's see if I can show it to you. Analysis, curve, and let me hide positions. Give me a second, guys. If I can remember how to hide my positions. Counts, show futures, trade, show positions. Take that off. So let's see what this looks like. Take the positions off, but it doesn't. I'm going to show you the risk graph. Let me show you. It's still going to show my thing there without showing my positions. Let's see if I can take that off. One second. So if I take all of these off, yeah, and that was the 44.10 and the 44.60. Yeah, here we go. So this is what a put debit spread looks like, right? It makes money if the market goes down. Remember? See, everybody see that? Makes money if the market goes down. So my maximum profit is 200 if it closes under here at expiration. And then my max loss is 50 if the price stays up here or goes anywhere down to this area here or keeps going up. So that's a losing trade. So then what I do is I say, okay, this is going to cost me $10. So now I'm going to go back to the table mode, and now I want to buy something or sell something to finance the purchase. Y'all, I don't like buying options, right? Okay, Beth, we'll see you later. I don't like buying options, but if I do have to buy options, I want to sell something to finance the purchase of that put debit spread. That's what that's called, a put debit spread or a put vertical, long put vertical. So what I'm going to do is, if it's going to cost me $10, I want to go down and sell something that I can collect $20 for. Everybody see what I'm saying? So that if I sell this, now I'm able to take in a credit of $11.50. And what does that look like? Let's go to the curve and see what it looks like. Then I've created this nice little thing to where I get to keep the credit if the market stays where it's at or goes all the way down to this area here. What is it, 44.60? And we're currently at the 46.10. I don't care if the market goes up. Look at this. I make money, and I make money all the way down. Look at this. I make big money on that put debit spread if we go past that. And I've got a break even way down here at 39.80. See the little hump right here? See that hump? So it's kind of like I'm selling a put, a naked put, and I'm giving myself a profit hump here by buying the put debit spread. So in other words, I'm using part of the money that I receive here from the sale of this naked put to buy put debit spread. This is called a 1-1-1 trade. And I put one of these on in multiple accounts every single day. And this is one of the best trades that, I mean, especially in this turbulent market, because think, it's got an automatic hedge in. It's got an automatic hedge right here. So if the market goes down, I make money, and it's got to go down way down to the break even of 39.80 before I lose money. This may be a little bit for y'all. I see some of y'all going, Kyle's like,
Well, I mean, well, isn't it not hedged because you have almost unlimited loss if it goes way down, right?
yeah, I mean, it says here that I could lose 19,893. But check it out. They're actually, now that's if SPY, the SPX, the E-minis all go to zero. The S&P 500 is not going to zero. But theoretically it could, and that's my maximum loss. What is more likely, Kyle, is my maximum loss if crap hits the fan is more likely to be the amount of buying power that I have to put up for the trade. These brokers know, their risk management teams know, whatever the buying power is that I put up is pretty much my max risk on the trade. So my max risk on this trade, theoretically, and it could be a little bit more, a little bit less, is $610. That's how much collateral that the broker is requiring me to put up to make this trade. It's a beautiful little trade though. Oh, it's a beautiful little trade because you make money if you go up, right? I'm going to make my $306 if it goes up. No, I'm not going to make the 306. I'm going to make whatever the credit is that I'm receiving. The max profit occurs here. Right, here's where I make the 306 at expiration. And I've got a way down here. Now, Kyle, here's what I do also though. I hedge even below this with other trades, right? So even though this one may be losing, I'll have additional hedges that'll lift up the profit here with other trades. That's what a hedge. Yeah.
So even though your maximum loss is $20,000 and probably will never happen, you only need $600 in an account in order to put this trade on?
Yes. Now, Kyle, again, that's the beauty and kind of the double-edged sword of span margin, right? Span margin is very attractive, but it's very dangerous if you don't know what you're doing. That's why I would say, okay, if I had a $1,000 account, would I put this trade on? Well, if you had, that's not fair. Because you would be using 60% of your buying power, right? If you had $1,000 account and you have a trade that costs $600 in buying power, you're using 60% of your buying power. Remember, I told you, probably don't go over about 35% of your buying power. So if you had $1,000 account, don't use more than $350 in buying power. Now, with smaller accounts, you have to, right? I mean, you just can't. That's why you need to build your account up. If you got a $10,000 account, you could use as collateral up to $3,500 of your account and be safe so that you're not going to blow something out. I've given you guys a lot today. Eric, you look like you're exhausted, dude. Eric's like, what the crap? You okay, Eric? Eric's good. It's a lot. And what I was hoping is that some of you guys would be able to punch the buttons. I want y'all to punch the buttons. I want y'all to try this stuff. That's the 1-1-1 trade. Now, what do we do on this trade? Well, there's different management techniques that I've been exploring. The cool thing is, what's this, Kyle? So if I am selling this for twice what this is, right? Well, once this gets to 50% profit, just this leg, I can close this and have an absolutely free put debit spread that is giving me $200 worth of protection to the downside. I have created a free hedge. All I've got to do is wait for time to pass. And on average, it's going to be about 18 days. In about 18 days, I can get about 50% profit from that naked component so that I close it. I have to buy it back for $10, but I sold it for 20 and I bought this for $10. So I'm even. So I've got this trade on for free. I've got a hedge on for free.
Yeah, okay, I'm saying that. So basically, because when you sell an option, it's going to be worth more the more time it has till expiration, and you're hoping that okay, so basically by the time that the strike price of by the time that the price of the underlying approaches that that really low spot where you start losing money, enough time has passed that you can then buy back. Okay, it's kind of Clifton here. I see the elegance behind it.
Yeah, I mean, think about the beauty of it. I sold it for 20. I'm going to wait till the balloon goes down so that I can buy it back for 10. And when I buy it back for 10, now I've made $10 and I've paid $10. So my net credit or debit is zero. So I've got a free hedge on. All right, so I've put on about 80 of these, okay? And I started doing this trade back in the fall. And would you say we've had very turbulent markets over the last few months? Not a single, now listen guys, doesn't mean that they're not all going to go to hell in a handbasket tomorrow. Not a one of them has lost money. Not a one of them has lost money. It's a really cool trade, even in a turbulent market. So all I'm trying to do is, and you're not going to leave this course going, I know exactly what I'm going to do. You're going to have options. You're going to have options with options to go, hey, wait a minute, there's a lot of different ways to skin this cat. And this is one of them, to where you could theoretically put on a very, safe trade, that's worked well in turbulent markets that will allow you to have a free hedge. And when you get a ton of them, like old Bobby does, let's get them back on here again. And let's show all our trades. You get something that looks like this. You create this nice little panel that has a huge hedge to the downside. I want the market to go down. I want the market to go down so that I can make $5,917. And you see my little soldiers. Here's all my little soldiers. It looks complicated, but it's fun as heck, y'all. I ain't lying. And then when the market goes down, you go, yay, market goes down. While everybody else is like, oh man, market went down today. And you're like, yay. All right, questions. Give you a bunch today. Kind of heavy. Everybody okay? Everybody having a good semester? I gave y'all last week off too. I gave you a really short little discussion this week. But I want you to know that even the professionals with their Rolexes and their yachts can fail. Right? All these people can fail. I can fail. We can all fail. We try not to fail, and we try to set things up that are hedges like this so that we don't fail. Right.
I mean, shouldn't that Cordier guy just, wouldn't all he have needed to do is buy some insurance in the form of like a low delta call? Am I saying that right? Like the guy who we watched the apology video for him, and he had, my understanding was that he had unlimited upside risk because he was selling calls and the futures just went haywire one day and it all just went to hell, right?
Yeah,
He didn't have head on it.
Yeah, he was selling stuff naked, right? And he didn't protect himself. He didn't have a hedge. I mean, as I think you said in your discussion, you know, hey, wasn't that your job to hedge this stuff? Yeah, you got to hedge this stuff. You can't just say, oh, you know, it only happens, you know, 5% of the time. You got to have a plan for when genius fails. Because you can sit here and go, wow, I got a plan, man. Rick trade, 95% of the time, it's going to make money. Okay, what happens when your strike is breached and you're in danger of losing, you know, that money? That's why I want y'all to start doing the Rick trade. I want you to roll that put. I want you to feel the fear of the strike price of the asset of SPX coming to your strike. And I want you to see how much money you're losing at the time and go, oh my gosh, if this was in a real account, what would I do? And I want that strike to be breached. And I want you to roll out in time. And that's when y'all gonna be texting me and doing all things. And I may send you a message and say we're having an emergency meeting, you know, or something, and record something of what to do if that strike is breached. But I want you to experience that. You got to experience that. Right? We've got to practice football Monday, Tuesday, Wednesday, Thursday, and get smacked in the mouth so that it doesn't take us by surprise on Friday night on the football field when we're playing a rival. You got to go through it first. You got to experience some of this. And once y'all do this, y'all are going to be, y'all going to be able to do some really, really cool things. Really, really cool things. And I think you're going to be able to enhance your return, but you don't do it too early. It's not time to turn loose the training wheels yet. You're learning a lot. So y'all be a little patient. Oh, by the way, I talked to Dr. Nielsen and I said, you know, I could actually teach another semester of this stuff. I mean, by keep going a little deeper and deeper. I mean, there's so much things that we could show you. So we're thinking about an investments too, right? Which could even go a little farther. So we'll see how that develops. He's wanted to do it for some time, so hopefully we could do something like that. Will this be for summer 22 or fall 22? That I don't know. So I've just reached out to him and said, listen, I think it's going good this semester. There's so much more that we could share. You know, I'd be up for doing an investments too, if you would allow us to. So he's very open to that. He said he's been wanting to do that for 5 years.
What would Jack Bottle say about all this?
What's that?
What would Jack Bottle be saying about all this option stuff?
Well, you know, and that's the thing. You know the secret, Kyle, right? What is the secret to accumulating wealth over time? The secret is consistency, putting money away on a regular basis in a low cost fund that tracks either the overall market or the S&P 500, maybe allots a little bit to bond, and don't over diversify. Equities are where your returns are going to come from, right? So put it in the S&P 500, put it in a total market fund. dollar cost average and wake up one day and be, be a millionaire. But I don't think you need gold, and I don't think you need silver, and I don't think you need corn, and I don't think you need wheat, and I don't think you need all of that, and I don't think you need international, and I don't, if you over diversify, Kyle, you're going to diminish your returns. What I'm trying to show you is this: do that. Do the all stock fund, right? Low cost fund. Do the S&P 500 low cost fund. If you want a bond component, do a bond component, and do that. Now, this is where you can say, hey, I'm going to try to enhance my returns. I've got an extra, $25,000, and it keeps you active in the market. I love this stuff. I do. I love it. But I don't want you to ever leave here going, oh man, I've got to do options. You've already got the secret. And everybody out there wants to overcomplicate it for you. Now, what I just gave you today, you're sitting there going, Bobby's overcomplicated. No. I don't want to take you away from your path to success. Your path to wealth and success is putting it in the stock market and hanging on, baby, for dear life, through good times and bad. And over time, things are going to do well in the market. Equities is where it's at. I don't see that changing in your lifetime, my lifetime, your children and grandchildren's lifetime. That's the secret. You've got the secret. You know the secret. Now, what is this we're doing? This is giving you a little advanced knowledge. Some of y'all will embrace this and try this. Some of you won't, and that's fine. But I hope you appreciate that you're receiving something that is not taught. And it's taught because people don't know it. So at least you'll be familiar. Can I give you one other thing before you guys go? What's this? Okay. Let's say you're some expert on SPX. Christy, can you talk?
Yeah, sure.
Christy, you're going to be a graduate of the University of Alabama. You came through the financial planning curriculum, and you survived Dr. Bob's investment class. And so you're a superstar now. You're a superstar. And you're asked to be on CNBC. And what do they ask people on CNBC, Christy? Do you know what they ask people that they come on there? What do you think about what? What do they ask?
I don't know.
Well, here's what they're going to say. Christy, what do you see for the remainder of the year for the S&P 500? Now, Christy, I'm putting you on the spot, but I want you to tell me, what do you see for the S&P 500 for the remainder of the year?
Oh, I don't.
Just make up.
Really?
I want you to sound official, girl. I mean, let her fly. I want you to convince me that you are the greatest stuff known to investing, and you know what the SP 500 is going to do. Just tell me
for the rest of the year.
That's it. What do you see it doing? But you're on CNBC.
Yeah, I mean it's just gonna be really volatile. It's gonna go up and down, and I don't know. I can't sound official.
Okay. Now, Kyle, you're kind of smiling. Eric, you're smiling.
Yeah.
You know that these idiots that get on CNBC don't know what the hell they're talking about. But I'm going to show you by using options how you can become the expert more than anybody on CNBC. Are you ready for this? Never forget this. Okay, you ready? What's this? I'm going to the option chain of SPX. Hey, Bob, what do you think about the SPX? Oh, Peter, I appreciate you asking. I'll tell you this. The SPX, here's what we're seeing for the remainder of the year. We're seeing that we're going to have a plus or minus move in the markets that the options are projecting of 855 points to the positive or to the negative. Oh my gosh, how do you know that? Because I know what I'm talking about. And the people on CNBC don't. Look, this tells you this is the expected move. So if we're at 46.22, simple calculator will tell you, the market is predicted in the options market to either be minus 855, a range of 3767. Let's open another one. Can y'all believe this? And they don't know how to do this. They just make up and pull stuff out of there. 3767 to 4623 plus 855. So if you're kind of anticipating this, you can say, yeah, let me tell you something there, Peter. Based on the volatility in the markets, we're projecting that the S&P 500, which is now 4623.49, will trade in a range of 3,767 to 5,478. Damn, is that good? Do y'all hear that? You just told them something that nobody on CNBC knows how to do. They're just saying, oh, well, I think it'll get to. No, you don't. All I had to do is go where? I went to the December 30th expiration, 22. I looked at the volatility is 20, implied volatility is 26%, which is reflecting a movement of plus or minus 854 points. I can tell you better than anybody that's ever. You think Jim Cramer knows how to do this? Oh, he has no idea that the market is expected to move 854 points plus or minus, and to be in a range of 3767 to 5478. Now, watch this. What if they ask you, hey, Bob, by the end of the year, what do you think the probability of us being at 3,000 in the market is? Peter, I appreciate that question. We have a 10.49% probability of closing below 3,000 in the market. God, is that powerful? You are now an expert, not just guessing as they do on CNBC. You've got statistical data behind you and the options price model that is speaking to you and telling you what the probability of success is. Now, I'm going to give you one more. You ready for this? Kyle, okay, so you say there is a 11% chance that we will close at or below 3050. What's the probability that we will touch 3050? Do y'all remember this one? It's 2 times the probability of being in the money. What's the probability that the market currently at 4622 will touch 3050? 22.16% probability. Oh, I love this stuff. Oh my gosh. Now you know. So you got a client, Eric, that comes into your office and says, hey, Eric, dude, I'm thinking that the market is going to go down from 4623 to 3,000. What do you think about that? I'd say that you are 89.5% wrong. I'd say that there's only a 10.5% probability of that happening. Do you see why quants rule the world? We don't need no stinking technical analysis. We don't need no stinking fundamental analysis. We let the numbers speak for themselves. And if you'll watch this stuff, the options pricing model for the Black-Scholes model is highly accurate. And it gives you something to be on CNBC and say, well, I'll tell you something, Bob. Yeah, we got about a 10% chance that the market would close below 3,000. I like those odds. It's not going to happen. But questions on that? Now you know how to impress people at Christmas parties, right? At Thanksgiving. You know, your Uncle Pete sitting there going, I'm worried about this market. I bet we go down to 4,000. Oh, really, Uncle Pete? Well, let me tell you something, Uncle Pete. You just pull it up on your phone and you go, you know, there's only about a 29.42% probability of us doing it. You gonna make a bet? You gonna make a bet? Because you got a 70% probability in your favor. Make a bet with Uncle Pete. Now you know how to impress people and to get on CNBC. Of course, they'll probably never ask you, but you know how to dazzle, right? So what's this? what's the what's the expected move for SPX for the RIT trade we put on? Well, the implied volatility for the 1-day options is 17.14%. We would anticipate a move of 33 up or down. So add 33 to 46.21, 33 down. So 46.22 down. Let's do that. 46.22 down. We got 46.22 is where we're at now. And the projected move is minus, say, 34. There we go. 45.88 is where it's expected to move tomorrow. 45.88. Where's my short strike? Where is my short strike of my RIT trade? Well below 45.88, isn't it? 45.30. I'm below the expected move. I got a 95% probability that ain't gonna be hit. I like those odds. Quants rule the world. Be a quant. All right, questions?
That was good. Thank you, Dr. Gaines.
Oh, absolutely. I want y'all to be able to use this stuff. I mean, you know, with your clients. Oh my gosh, the market's going to market's going to 5,000. Oh, really? Genius. We're going to 5,000 by the end of the year. Okay. Let's do that one, then we'll let you go. 5,000 by the end of the year. Here we go. All you got to do is come here to the end of the month. You know, we're going to 5,000. Okay, genius. 5,000. What's the probability of that happening? All right, Lisa, I want you to do it for me. What's the probability that will close above 5,000 by the end of the year?
Between the 25 and 27%.
27%, right? Because you're looking on the call side now, right? So we're looking on the call side to make this upward predict. So the probability is 27%. Lisa, what is the probability that the market will touch 5,000 before the end of the year? Not close above it.
I'm looking at the other side, it's 73%. Am I looking at the right thing?
Remember, touch is 2 times the probability of being in the money. So if you're at 27%,
50%.
at 54%, right? Now, and that's just an approximation, right? You can come back and change that to, let's see, probability of touch. Let's see, probability of touching. Here we go. This is approximation, but you can even pull it up and get specific with it. Probability of touching is just like I said, 56%. Probability of touching. I love it when I teach this thing to people and they're like, oh my gosh, I never knew you could do this by looking at the options market. So you're sitting there going, why am I using the options market and teaching the options market? It's not just so you trade options, it's so that you can get some indication for how the market is pricing options and it's pricing movements in the market. It's beautiful, y'all. It's beautiful. All right, great session. I hate that I went a little long. Y'all have a great week, and I will see y'all Thursday.